What's going on, Legacy Hack viewers, listeners? Thank you so much for subscribing. Thank you so much for tuning in. It's Jack and I actually back together again. Love having Jack. We are going to be doing some solo episodes though, guys. So just know that's going to be kind of coming, But we are going to come back together to do some episodes with with the show. Who knows? We might actually even have a guest. That actually could very well happen. But like always with our channel, this is for education. Whether or not you're actually practicing, infinite banking or family banking, or you're actually just learning about it. You might have just said, "Hey, man, what does IBC even stand for?" This is a resource. This channel is a resource for that that we want to provide for you and communicate to you, because not only are Jack and I, actually, yeah, we're offering this, selling this, helping people, get into this vehicle, but we're actually practicing this ourselves. We actually have our own policies. We have our own, family banks that we're actually doing this right now. And so we are actually uh, real practitioners, so to speak.
Indeed.
But today we wanted to kind of go down a rabbit hole of that's a little bit of a hot topic. I feel like sometimes within the infinite banking world, and that is whole life versus IUL, or index universal life insurance. And I think Jack and I can at least share some perspective on that. And Jack's going to kind of lead us today. So Jack, take it away, brother.
Yeah. Yeah, it's interesting. When I first got into this business in 2020 with our team at Unbridled Wealth, we only sold whole life. Yeah, when you get into that, you start talking about like, oh, the base versus paid up additions split and how efficient can you kind of create early cash value that is available to borrow against and use for other opportunities. And then I think in 2022, website that I learned from is called bankingtruth.com. And the guy in there talks about using IUL for this personal banking system as well. And that was kind of eye-opening to me. And when I started reading his articles, I was like, oh, this guy has like done a very deep dive on this and knows what he's talking about. And that caused us to then talk with our primary carrier who has
And
a
that was Jack, that
product.
was bankingtruth.com.
Yeah, bankingtruths.com. I'll pull up a visual for us in a second that actually comes
Okay,
from that website.
sweet.
Um, but yeah, our general agent at Unbridled Wealth did a deep dive with our carrier and found like, oh, we have this early cash value rider available to us. We can create a minimum non-mech design with IUL and have access to often like 95% of what you pay in year one, at the end of year one. And it's funny, I have a IUL now on my wife, and actually I'm tracking to have more cash value at the end of year one than what I paid into it with premium because I'm
Wow.
going to get some strong index credits, which is like that can't happen with whole life. So yeah, it's an interesting topic. I'll pull this slide up, but yeah, curious, Tyler, like how did you kind of first, was it a decision for you of choosing between whole life or IUL when you set up your family policies?
Yeah.
Yeah.
So when Ryan was kind of walking me uh, through the process, when I was just on the client side or actually exploring setting things up, at the end of the day, Ryan, I guess what happened is that I Amy and I, we got a policy on Amy and the kids, whole life, and then I've got a policy on me, this a IUL, and Ryan kind of explained it to me um, in very simplest terms that yeah, the IUL side is a lot more flexible. Yeah, it's a little bit more complex, and you need to have a little bit of intuitiveness with the stock market, okay, and what that's doing right now. And because of my background with options trading and dealing with the stock market at the time up until that point, um, I felt comfortable with that. And then he just kind of let me know that the whole life side, was more of a kind of much simpler, much easier to understand. Um, and that was the reason why he did it. And I'll be honest, I just trusted Ryan.
Hmm.
At the end of the day, that he was leading me down the path that was right for me and my family, and also it was a good blend. Okay, that
Yeah.
I had both products in house with me and underneath as far as my bank, and yeah, so that was kind of how I got into, or kind of how I was introduced to this whole side of things. It wasn't like we're only doing whole life, Tyler.
Yep.
Don't think about anything else. That wasn't the way it was presented to me.
Yeah. Yeah, I think that's unique among agencies and agents who teach others about the infinite banking concept. I mean, infinite banking is using whole life with a mutual carrier. It's not IUL, so we'll make that distinction. Like IUL is outside of the definition of infinite banking, but it is still permanent life insurance that has cash value that can be borrowed against. So you can still do the banking process with it. But here's a little more nuts and bolts of uh, how it works. You alluded, Tyler, to the flexible premium structure with IUL. With whole life, you always have a required base premium, whereas IUL, you could pay in $0 of premium in a given year, and they would just deduct the cost of insurance and policy expenses from the existing cash value. You don't want to do that for like ongoing, or you can cause the policy to collapse on itself. Um, and then the cost structure, like I just hinted at how IUL can have very high early cash value. And that's because IUL costs are annually renewing term. So when you first start a policy, that's the youngest and healthiest you'll ever be. So the cost of insurance is very cheap, and then it'll get a little more expensive every single year. Whereas whole life, it's fixed cost of insurance the whole time. So it's actually more expensive up front when you're young and healthy. But then as you get older and that cost stays the same, it actually becomes very cheap in the long run. And that's just kind of their different internal structures.
And I think, Jack, if I'm not mistaken, I mean, that's one of the big things right there that, you know, that, you know, like the unbridled wealth or other brokerage firms, insurance brokerage firms that are doing infinite banking, one of the big things is that right there, the whole cost of insurance and
Hmm.
how it's outlaid through the life of the policy. That's what I've heard. And as
Yeah.
I've done my homework, I mean, is that something you found too?
Yeah. Yeah, definitely. Like, I mean, yeah, we're familiar with firms within our primary carrier that always do like a 40/60 like base to paid up addition design, or like a minimum non-MEC, whereas we always use like a term rider on our whole life policies so that we can drive the base premium down to like 20%. And that ultimately like creates more flexibility for the client. Like in a $10,000 a year policy, 2,000 would be the minimum that you have to pay, and then you can pay up to 10. Whereas IUL, you could in a 10,000 a year design, you could pay between 0 and 10 every year. But really, like, yeah, I think I'd advise as we consider this, like, you want to be max funding a policy for the first 5 to 10 years, if possible. We've found kind of the minimum viable amount for an IUL is max funding 3 out of the first 5 years, gets the policy growing in a sustainable way. Um, And yeah, I guess I'll highlight too the growth. So like with IUL, you can track index like the S&P 500 between like 0 and 10%. So that's what you can grow at year to year. Whereas whole life is very smooth glide path, as it says. You get your 3 or 4% guaranteed credit plus a dividend at the end of the year, which are not guaranteed, but all mutual carriers basically have never missed a dividend in their existence. So, um, yeah, but IUL, you can kind of break even on what you've paid in after year one, potentially, often more like year three or so, depending on health and age of the insured. But whole life, it's more like between years 5 and 7 that you break even. Um, so yeah, it just kind of depends on your goals, your risk tolerance, I think which one to choose, how you earn money and the flexibility you want as it regards to premium. But both of these will safely grow your capital and will create cash value that you can borrow against and use for other opportunities. So yeah, it's kind of funny. Like I'm sure most people are given a decisive like whole life or IUL, but it's like either of these can work. Yeah, we both own both products, which is a cool thing. And um, yeah, they're awesome tools if when structured and funded correctly.
Yeah. I mean, Jack, that those last two things that you just said is they are structured properly
Mhm.
and they are funded properly.
Yep.
Okay. That I think that, if you're a brand new person with IBC and you're considering this, I think you have to have the mindset, especially either with whole life or either with um, IUL. But the IUL, because it presents a little bit more flexibility, you still need to have at least a 5 year mindset that, man, I'm going to do whatever it takes to put the money in at the minimum side, whatever that number is. And that's where you and your agent kind of have to kind of work with that of like, okay, what is it that you feel comfortable over the next 5 years that you can put into this policy, and so that it actually becomes what we call efficient.
Hmm.
And, it's and Jack, I think it's kind of where that we're actually you start to see whereas in the beginning of most policies, um, on the IUL side and the whole life side, they're both the same kind of where that for every dollar you put in, and correct me if I'm wrong, but this way I've done it in my brain is like for every dollar I put in, those first, especially 3 years, 5 years, you're only getting maybe for every dollar, it's like maybe 85% or 85 cents for the dollar. Then it
Hmm.
might go the next year, it might go to 90 cents for every dollar you put in. And then eventually, after a while, the IUL can actually do a whole lot faster
Hmm.
because the potential is higher. The whole life's just going to be steady as you go. Like you're saying, that 5 to 7 years is more the outlier. Whereas, I think you even mentioned your wife's policy, within your first year, you're already kind of seeing almost that 1 to 1, if not more, of that return on inside the policy. Is that right, Jack?
Yeah, that's correct.
Yeah.
Yeah, an early credit of 10, 12% on your account value will jump you past what you paid in if you have we put a 99% early cash value rider, which basically
Mm.
just spreads the agent's commission out, so
Yeah.
that you don't have much surrender charge at all, which typically would, yeah, like give you access to like 60% of what you pay in year one if you didn't have that on, which makes whole life, like with a 2080 design, more favorable in terms of early cash value. So
Yeah.
yeah.
Yeah. So I don't want to. I mean, I don't want us to like focus so much on the internal rate of return, which it is a part of it all, you
Hmm.
know, and how you see your money kind of grow inside. But again, this is to be used as a bank, and it's supposed to be used as when you can pull leverage. And, like you were talking about the IUL, the early access to that money, that's kind of attractive.
Hmm.
That's why the IUL is there. So I mean, I've always liked what Jonathan said that, and his analogy is just really good, and that analogy is um, it depends on the situation for the client, and what he means by that is he's like, do you need a nail or do you need a screw? They both do the same thing, but they do something different when they're used.
Hmm.
Okay, they're the same thing, but it's how that it is applied or how they're used. So, that's kind of how I've always looked at it and used it whenever I'm communicating with a client to help them understand like both of them are good. It's just
Hmm.
what exactly is the purpose or use behind the actual item, the
Yep.
tool that we're using. So, so yeah. Any other last thoughts, Jack, as we wrap this up?
Um, yeah, I think maybe just the mindset that you were hinting at of like, yeah, view this as you're starting your banking business. It can be done with either product, but the most important thing is that you capitalize your system and you fund it well in those early years so that it can be a very helpful, profitable tool for you in the long term. Um, yeah, and it's up to you which one you want to go with, and we can help structure it the right way with either product, which again I will say is unique in this industry. So,
Yeah.
yep.
I love it. I love it. So, Legacy Hack, hey guys, we're done. We're calling it a wrap. We're landing this plane right now. But we appreciate you guys tuning in as always. If you want to get a hold of Jack or myself, our calendar links are down below. We'd love to set up something with you just to have a conversation about it. And there's nothing wrong with the conversation. Last time I checked, that's what my granny used to say. There's nothing wrong with talking. So there you go. So, Jack, thank you again so much for that deeper dive and leading us kind of through that. I thought the illustration was great. But outside of that, guys, we're done and we'll call it a wrap. Have a great night.